Hi, my name is Stuart Weems and welcome to the Investopoly podcast. My goal is to share easy to understand evidence-based holistic insights to help you master the game of building wealth. And in my regular Wednesday episodes, I talk about the theories, methodologies and principles associated with investing and developing financial plans and so forth. The aim of this case study episode is to share how it all works out in real life by talking about some of my existing clients. And today's case study is about a client that has been kind of anti-property, if you like. That is, he's never really been keen to borrow to invest in property. And most of my clients do that, borrow to invest in property, of course. His reluctance has been, that property is expensive and, he's just not comfortable to, he knows he has to go and borrow more than $1 million to go and buy something that's decent and he just doesn't feel comfortable with that. Anyway, and I thought it was a really good case study episode because it's a little bit different to the norm, certainly from if you look at my client base. And it doesn't matter, it's good that you have an advisor that is what I would term asset class agnostic, which means that, from my personal perspective, I don't care what my clients invest in. Could be all property, could be all shares, whatever's going to work, whatever suits them. And if it's going to work for them, like in terms of it's enough, they're going to be able to fund retirement, then I'm all for it. Now, I think generally most people would benefit from investing in both property and shares. But as I said, if you've got a real problem with one of those asset classes or even another asset class, and, you can't be convinced or educated that, you should broaden your mind a little bit or change your view, I should say, then that's fine. We can kind of live with that. Okay, so let's talk about the numbers then. I've been working with this client the last 8 years. So started working together in about 2016. And at that stage, he had a share portfolio worth about $760,000. But it had about, ironically, $600,000 of debt against it. So a relatively highly geared share portfolio. I say ironically because he wasn't keen to borrow to invest in property, but he obviously comfortable borrowing to invest in shares. That's fine. His super was about $240,000 and his wife's was about $80,000. Had about $440,000 of income. That was his professional income. Wife wasn't working. And about $100,000 of living expenses. His home was worth $2.5 million. He'd already repaid all that debt and then obviously borrow against the equity to go and invest in shares. And so his net investment assets were around about $500,000 when we started working together 8 years ago. And the impetus to work together was that he received an inheritance about $400,000. So actually, let's say his net investment assets were about $900,000. Like that's the beginning mark, if you like. Now that was 8 years ago, and obviously the share market's done okay over that time. His net investment assets have grown from $900,000 8 years ago to $3.2 million today. His income hasn't really changed over that time. Probably his expenses have changed a little bit, but probably not much. So at the moment, he's got his share portfolio is worth nearly $2.2 million, and the loan has increased a little bit. It's $725,000. So we haven't done a lot of additional gearing. Remember, it was $600,000 8 years ago. It's only an extra $125,000 over the last 8 years. So we haven't done a lot of additional gearing. His super's tripled thanks to obviously his contributions and so forth, and obviously returns. So he got $750,000 in super, and his wife's got $320,000. So let's call it across the family about $1 million in super. He went and bought a holiday house and borrowed to do that. So the holiday house is worth 1.7 with about $1 million of debt there, and we bought really well. I mean, we sort of coached him around the decision to do that and to buy well. So sort of take that investment lens approach towards the holiday home purchase. That is, we want to buy something that's going to have a bit of growth. And he only bought it 2 years ago for 1.4. So we've seen about $300,000 of growth or equity in that, thanks to a little bit to the COVID sort of boom over that period of time. As you can see, it's mostly driven by the share market. Really, super and shares have done sort of all the heavy lifting, if you like, in regards to increasing or tripling, really, his net worth. So it's been a pretty good outcome, I guess, for this this client. So as you know, I like to sort of sit back and go, well, what can we learn from this case study? Because that's the whole point of me trying to share these episodes to, share how other people have built wealth, and then what can you learn from their journey? Either what could you do differently or what could you repeat? So the first observation is I'm pretty sure he would have benefited from borrowing to invest in property, which is kind of our advice 8 years ago. And so, he would have done pretty well. I mean, he bought a house in Queensland. He probably would have made almost $1 million probably of equity over that period of time. And, obviously would have enjoyed some tax benefits to sort of help the carrying costs of that investment. But equally, it's not necessary. And we realised that when we modelled out his scenario and his situation, we realised he's going to have enough assets. If those assets sort of repeat the performance over the next 8 years, he's going to be in a really strong position. I think we'd all agree with that. So I think the learning here is you don't have to, depending on your situation, of course, and what your goals are, you don't always have to invest in property and you don't always have to have gearing. I note that he had some gearing in the share market. He's quite heavily leveraged. As I said, his share portfolio was 760 with 600,000 of debt. So he didn't have a lot of equity in the share portfolio. And as you can see, we haven't increased that borrowing very much over the last 8 years because I thought that was pretty highly geared. I wasn't particularly comfortable with that level of gearing. So, it's not necessary. It really just depends on building a strategy that's going to really suit your situation. The next observation is he's very good at, I guess, managing his money. So in terms of, keeping good records, managing cash flow really well or quite closely, managing performance of investments, he's probably one of the only clients that I don't have on a investment platform. So he just uses a CommSec account or a share trading account and does most of the work himself. I've tried to talk to him about the benefit of a platform, but anyway, it is what it is. And I think, there's that saying, what gets measured gets done. And it's really true. I think managing cash flow, having a general idea, how much you're spending, where is it going, how your investment's performing, all those sorts of things, which is, the sort of thing that a financial planner does anyway, is really good. But if you're focused on it, that means you and the planner are then aligned. Whereas if you're completely disinterested in your own financial position, from a financial planner perspective, so from my perspective, that's really difficult to work with a client like that because I don't motivate people to build wealth. I just work with people that are already motivated to build wealth. The former is just exercise in futility, really, and all you're just going to do is irritate both of you. So I think the common trait of a successful investor is that they are motivated to build wealth and that they do measure their wealth, their income, their cash flow, all these sorts of critical things over time. And what gets measured tends to obviously improve. His share portfolio consists of mostly ETFs, as you'd imagine, because obviously we use a passive, rules-based, low-cost methodology. So we've certainly directed him around that. He does have 3 direct stocks and he does have a reasonable exposure. It's not huge, but a reasonable exposure to Macquarie Bank as one of those 3 direct stocks. Now, he owned that or held that before we started advising him, so we didn't go and tell him to buy it, of course, but that's done quite well as well. And also he's got a US ETF as well, not US tech, but S&P 500. I think the index is a little bit broader than that. So he's kind of rode that wave over the last 8 years as well through that US exposure. Now we're talking to him now, and we have been over the year to sort of diversify away from that, but he has had a couple of winners there. The timing has been perfect in terms of driving returns. Now you can't always bank on that, of course, and you can be randomly lucky in terms of timing sometimes. Sometimes you can do it by design, but it doesn't matter anyway, because even if the returns weren't as good as the US returns or what Macquarie's done over the last few years, the long-term returns, in terms of the way we're investing the vast majority of his money, is always going to work. And the last one is that whilst the holiday house was very much driven by a lifestyle decision, again, he was kind of anti-investment property, he was astute enough to follow the advice to get a buyer's agent to help him to buy well and buy something with a strong land value component, a really good location. And again, that's worked out well from him from an equity perspective because, as I said, he's enjoyed about a $300,000 uplift in value, probably more than that actually. But it's good when, clients take advice and, that try and make the best financial decisions for themselves rather than, but sometimes, when looking at a holiday house, you can go, well, why would I pay a buyer's agent 30 grand or whatever they charge? That's just going to add to the cost. Well, ultimately, we've got to buy well, because if we're going to hang on to this thing for 20 years, buying well versus not buying well could cost me several millions of dollars in terms of opportunity cost. Anyway, I just thought I'd share this case study because I thought it was an interesting one. As I said, very little gearing, certainly no investment properties in there, but it shows that if you manage cash flow well and you invest your money well, it does work in the long run. Okay, until tomorrow, bye for now.